WeWork's story begins in 2010 with two ambitious entrepreneurs, Adam Neumann and Miguel McKelvey. Their vision was simple, yet revolutionary, to transform the traditional office space into a vibrant community hub where creativity and collaboration could flourish. They believed that the future of work was not confined to cubicles and rigid office structures, but was dynamic, flexible, and driven by human connection. With this vision, they opened the first WeWork location in New York City, offering freelancers, startups, and small businesses a chance to work in an inspiring environment. Little did they know, this small experiment would soon turn into a global phenomenon, attracting millions in investment and rapidly expanding across the world. But as we'll see, the seeds of WeWork's eventual downfall were planted even in these early days. Join us as we delve into the fascinating journey of WeWork, beginning with its visionary start, through its meteoric rise, and finally its dramatic fall. I'm sure you've heard the news about WeWork's dramatic rise and fall. I bet you didn't know how a $47 billion company could collapse so quickly. In the world of business, few stories captivate quite like the rise and fall of WeWork. WeWork began with a vision to revolutionize the way we work, offering shared office spaces designed to foster collaboration and community. However, beneath the surface of this meteoric rise lay cracks in the company's foundation. From its ambitious beginnings to its dramatic downfall, we'll explore the key moments that defined WeWork's journey. This video will cover various sections including the rise and fall of WeWork, its strategic partnerships, cultural magnetism, financial discipline, misguided ventures, the impact of the pandemic, and the lessons learned from its journey. Please subscribe to IGO Tech for more insightful content. The year 2019 marked a turning point for WeWork. As the company prepared for its highly anticipated IPO, scrutiny from potential investors intensified. The IPO prospectus revealed the extent of WeWork's losses and raised serious questions about its corporate governance and Neumann's leadership. The company's valuation plummeted, and the IPO was ultimately withdrawn. Neumann was ousted as CEO, and SoftBank was forced to take control of the struggling company. The COVID-19 pandemic dealt a further blow to WeWork's already precarious position. In November 2023, WeWork filed for Chapter 11 bankruptcy protection, marking a stunning fall from grace. WeWork's demise is a reminder that even the most promising startups are not immune to the forces of market dynamics and economic downturns. Our story takes us back to 2008, a time etched in history for the global financial crisis. It was during this tumultuous period that the seeds of WeWork were sown, as entrepreneurs Adam Neumann and Miguel McKelvey recognized an opportunity amidst the crisis. We saw businesses struggling with high rents and long-term leases. It was clear there was a need for more flexible and affordable workspace solutions. The year 2008 also witnessed the emergence of a transformative concept, the shared economy. Neumann and McKelvey saw the potential of the shared economy to revolutionize the office space market. We wanted to create a community, a place where people could come together, work, and thrive. WeWork's timing was impeccable, setting the stage for its rapid ascent. WeWork's first co-working space, launched in New York City in 2010, was an instant success. The company's stylish and modern offices proved to be a hit with freelancers, startups, and even larger companies. WeWork's early success coincided with a period of historically low interest rates, making it cheaper for businesses to borrow money. This environment of easy money fueled WeWork's rapid growth. WeWork's success stemmed from its innovative approach to office spaces. The company challenged the traditional office environment by creating stylish, modern workspaces designed to foster collaboration and community. Adam Neumann. We wanted to redefine what an office could be. This focus on technology and user experience further differentiated WeWork from traditional office providers. With its innovative approach to office spaces, WeWork embarked on an aggressive expansion strategy. The company's growth was fueled by strategic partnerships, acquisitions, and a relentless pursuit of new markets. SoftBank representative, WeWork recognized the importance of partnering with key players in the real estate industry. This aggressive expansion strategy propelled WeWork to become a global brand. WeWork's success was not solely attributable to its physical spaces. The company also excelled at cultivating a strong sense of community.
WeWork recognized that people craved connection and a sense of belonging.
WeWork hosted regular events, workshops, and networking opportunities, creating a vibrant and engaging work environment. This focus on community building created a powerful network effect, attracting new members. As WeWork continued its rapid expansion, investors took notice.
Venture capitalists poured billions of dollars into WeWork. In 2019, WeWork reached a staggering $47 billion valuation. However, beneath the surface of this remarkable success story, cracks were beginning to emerge.
WeWork's meteoric rise was fueled by its aggressive expansion strategy. The company seemed to be in a race to open new locations, gobbling up office space globally. This rapid expansion created a significant financial burden for WeWork. WeWork's aggressive growth strategy ultimately proved unsustainable and sowed the seeds for its downfall. Section 2. A culture of excess when financial discipline takes a back seat. WeWork's rapid rise coincided with abundant venture capital funding, leading to lavish spending. Flush with cash, WeWork developed a culture of excess. The company spared no expense in designing its office spaces. WeWork's stylish offices raised eyebrows about its sustainability. WeWork's spending extended to marketing and advertising. Lavish marketing campaigns featured celebrity endorsements. These efforts raised WeWork's profile but added to losses. WeWork's culture of excess extended to corporate governance. Adam Neumann's extravagant lifestyle and unorthodox practices. Section 3. Misguided ventures and the illusion of diversification. In its quest to become more than just a co-working space provider, WeWork embarked on a series of diversification efforts that ultimately proved misguided and costly. The company seemed to believe that its success in the co-working space market could be replicated in other industries, leading it to invest in a hodgepodge of ventures that were often unrelated to its core business. These ventures range from co-living spaces and education initiatives to wave pools and a proposed WeWork city that would have encompassed all aspects of urban living. While diversification can be a sound business strategy, WeWork's approach to diversification seemed haphazard and lacking in focus. The company spread itself too thin, investing in too many ventures without a clear understanding of the markets it was entering or the complexities of the businesses it was acquiring. WeWork's foray into co-living, for example, proved to be a costly misfire. The company's WeLive brand, which offered furnished apartments with shared amenities, struggled to gain traction in a competitive market and was plagued by operational challenges. WeWork's other ventures met with similar difficulties, failing to generate significant revenue or profitability and diverting resources from the company's core business. Section 4. The warning signs emerge, seeds of doubt and the looming crisis. As WeWork continued its rapid expansion and diversification efforts, warning signs about the company's financial health and business model began to emerge. Industry analysts and observers raised concerns about WeWork's mounting losses, its high cash burn rate, and its opaque financial reporting. Despite these warning signs, WeWork's leadership remained publicly optimistic, touting the company's growth prospects and dismissing concerns about its financial stability as unfounded.
However, Behind the scenes, cracks were beginning to show in WeWork's facade. The company's reliance on short-term leases and a steady influx of new members to fuel its growth made it particularly vulnerable to economic downturns or any shift in market sentiment.
Moreover, WeWork's aggressive expansion strategy had resulted in a complex web of leases and financial obligations that would prove difficult to unwind if the company faced financial difficulties. As concerns about WeWork's financial health grew, so too did scrutiny of Adam Neumann's leadership and the company's corporate governance. Neumann's lavish lifestyle, conflicts of interest, and unorthodox business practices, once viewed as quirks of a visionary entrepreneur, were now seen as red flags by investors and industry analysts.
The stage was set for a dramatic fall from grace.
Exposing WeWork's fragile foundation. By 2019, the tech industry was experiencing unprecedented growth. Venture capital flowed freely and valuations soared. However, a sense of unease was brewing. Analysts questioned the sustainability of the tech boom. WeWork, with its $47 billion valuation, became a poster child for excess. The company's reliance on venture capital made it vulnerable. In the fall of 2019, these concerns came to a head. Investors became more risk-averse and valuations tumbled. WeWork's IPO plans were put on hold. The company's future was suddenly in doubt. Section 2. The pandemic strikes, a crisis that exposed WeWork's fatal flaw. Just as WeWork was reeling from the bursting of the tech bubble and the fallout from its failed IPO attempt, the COVID-19 pandemic struck, delivering a devastating blow to the company's already precarious position.
The pandemic, which forced businesses worldwide to shut down and employees to work from home, exposed a fundamental flaw in WeWork's business model, its reliance on short-term leases and a steady influx of new members. As offices closed and employees transitioned to remote work, demand for co-working space plummeted.
WeWork's once bustling offices, designed for collaboration and community, sat largely empty, generating little to no revenue. The company's short-term leases, which had allowed it to grow rapidly during good times, now became a liability, as members were quick to cancel their memberships or seek rent relief.
The pandemic's impact on WeWork was swift and severe. The company's revenue streams dried up, its losses mounted, and its once lofty valuation tumbled further. WeWork, which had been struggling to stay afloat even before the pandemic, was now facing an existential crisis.
Section 3. A downward spiral from failed IPO to desperate measures. The confluence of the tech bubble burst and the COVID-19 pandemic sent WeWork into a tailspin from which it would never recover. The company's failed IPO attempt had exposed its financial weaknesses, eroded investor confidence, and left it with limited options for raising capital. The pandemic, meanwhile, had decimated demand for its core product, leaving it with vast amounts of empty office space and mounting financial obligations. In a desperate attempt to stay afloat, WeWork's new leadership, which had taken over following Adam Neumann's ouster, embarked on a series of cost-cutting measures and strategic initiatives. The company laid off thousands of employees, sold off non-core assets, and renegotiated leases with landlords in an effort to reduce its expenses and conserve cash. WeWork also explored various financing options, including seeking additional funding from existing investors and exploring a potential sale of the company. However, these efforts proved insufficient to stem the tide of losses and restore investor confidence. In November 2023, after years of turmoil, WeWork filed for Chapter 11 bankruptcy protection, marking a stunning fall from grace for a company that was once hailed as a revolutionary force in the world of work. The high cost of uncontrolled growth. WeWork's rise and fall offers a sobering lesson for startups. Rapid growth can be a double-edged sword.
Growth without financial discipline and market assessment can lead to disaster. WeWork's aggressive expansion masked financial weaknesses.
Rapid expansion outstripped their ability to manage operations effectively.
Sustainable growth must be planned and aligned with market demand. Prioritize profitability and financial stability over vanity metrics.
Section 2. Beyond the bottom line. The importance of ethics and corporate governance. WeWork's demise was not solely due to its flawed business model and unsustainable growth strategy.
The company's downfall was also a consequence of questionable corporate governance and a lack of ethical leadership. Adam Neumann's extravagant lifestyle, conflicts of interest, and unorthodox business practices, while initially overlooked during the company's boom years, ultimately eroded investor confidence and contributed to WeWork's downfall.
WeWork's story serves as a stark reminder that ethical leadership and strong corporate governance are not merely optional extras, but essential ingredients for long-term success.
Companies that prioritize short-term gains and personal enrichment at the expense of ethical considerations and shareholder value are ultimately building their businesses on shaky ground.
Transparency, accountability, and a commitment to ethical conduct should be ingrained in a company's culture from the outset, fostering a work environment where integrity and responsibility are valued and rewarded.
Investors, too, have a role to play in demanding higher standards of corporate governance from the companies they invest in. By conducting thorough due diligence, asking tough questions, and holding company leaders accountable for their actions, investors can help to create a business environment where ethical behavior is rewarded and unsustainable practices are not tolerated.
The WeWork saga stands as a stark reminder that sound business practices still apply.
WeWork's rise and fall highlight the perils of unchecked ambition and the need for ethical leadership.
True innovation extends beyond disruptive ideas and catchy slogans. Sustainability, both financial and ethical, is paramount.
Investors now demand greater accountability and a clearer path to profitability.
The WeWork saga has served as a catalyst for positive change. It has forced a reassessment of priorities and a focus on sustainable growth.